it's been. Let's start off by looking at Australia. Now, back in the first quarter, the March quarter of this year, the Australian market defied gravity and was positive 2.2%, while markets everywhere else were negative. Well, we've caught up with the rest of the world in this quarter, and you can see here that the Australian market, the ASX 200, is down minus 11.9% in the quarter. And you can see we're also showing in the chart the volatility, which was fairly benign in the last half of last year, but really started to kick up as we launched into 2022. And of course, it's all got to do with the fear of interest rates, and the interest rates are a consequence of inflation, which is much higher than what was expected back at the start of the year. It's been compounded by the Russian invasion of Ukraine, which has really kicked up prices in food and energy. But the Australian market hasn't done as badly as overseas. The S&P 500, that's down 16% for the quarter, and it's been down as much as 20% over the first half of the year, and that's what they call a bear market. Now, the high-tech stocks, which I'm representing here by the FANGs, Facebook, Apple, Netflix, Google, well, they're down here 25%, and they've been down as much as 30% over the first half of the year. A quick look overseas, the rest of the world, well, they're down minus 8.4%, and emerging markets, perhaps surprisingly, are down only 3.3%. So a quick look at bonds now, and here we're showing the quarterly return of bonds. That's the Australian Bond Composite Index, and as I'm sure you've heard, it's been the worst half year in bonds for more than 50 years. But if you have a look at the yield, that's a 10-year government yield that we're showing there as well, you can see that sort of turned a corner. Now, that's a reflection that we may have reached the peak of what's happening in the bond world. In other words, cash rates, higher cash rates are already priced in. And if we hit those higher cash rates, it's going to significantly slow down the economy. The cost of living is really going to go up for many, many households. So the bond world is saying, we've hit the peak and they're starting to come down. Remember too, there is a tension here between those higher yields and also the fact that bonds are now seen as a flight to safety as the equity markets are falling. Now, I've seen in the media that this is, the worst financial year in many, many years, and it's a negative return in people's superannuation funds. All that's true, but it is important to realise that it's not that uncommon to get negative returns. This is a chart showing the growth of wealth of the ASX 200, in other words, how that increases year on year on year, and with that are the annual returns. And you can see that having negative financial year returns, perhaps it's not quite as uncommon as the media might have you believe. Now, I don't know whether we've hit the bottom in the equity world. We probably have hit the bottom in the bond world. Equities, not so sure about. But one thing I do know that we've got data on is how markets recover after downturns. And in the chart here, you can see that after 1 year, then markets have fully recovered. Even after a 10% downturn, a 20% downturn, over 5 years, the returns are fairly impressive after those downturns. So market downturns are not that uncommon, and the recovery tends to be fairly quick, tends to be within a year fully recovered. What's going on at the moment is unexpectedly high inflation, which is pushing up interest rates much higher and faster than originally anticipated, and that's certainly causing a great deal of uncertainty in the equity world. But it's not uncommon. When you look at the chart here, where we're looking at the world equity market from 1970 until today, you can see that there are lots of events that happen which cause the market to wobble around. They're very unsettling when you're in the middle of it, but keep in mind that periods of volatility, market downturns, and even economic recessions, they're not that uncommon and they don't tend to last that long.